Hola, muy buenos días. Les habla Carles Gaju, gerente de distribución institucional. En nombre de BICE Inversiones, les doy la bienvenida a nuestro webinar. Hoy nos acompañan Ralph Manny, Head de Investor Relations, y Daniel Baleiro, quienes están a cargo de la relación con inversionistas, y Aaron Miller, miembro del Comité de Inversiones y Head de la Estrategia de Venture Capital, quien junto a Luke Rossiter y Dave Shecker están a cargo de la estrategia de Venture Capital. Ellos estarán a cargo de la exposición de hoy acerca del fondo de Commonfund Capital Venture Capital 14, donde expondrán sobre las ventajas de invertir en Venture Capital de la mano de Commonfund, quien cuenta con 30 años de experiencia a través de sus 14 fondos de Venture Capital, permitiendo invertir en top managers con acceso restringido. BICE y Commonfund han trabajado juntos por más de 5 años, asesorando clientes y ofreciendo productos de private equity con foco a small y mid market. Y fondos de impacto, entre otros. Al final de la exposición tendremos tiempo para conversar con el equipo, por lo que pueden ir escribiendo sus preguntas en el chat y después, junto a José Antonio Sangüesa, las iremos revisando y, para ordenar la sesión de preguntas. A continuación, los dejo con Daniel, así que muchas gracias por estar aquí con nosotros hoy día.
Hola, muy buenos días, Carles. Buenos días a todos. Me alegra mucho estar con ustedes hoy día, pero de verdad me hubiese gustado estar presente tomando un desayuno con ustedes en Santiago. Como Carles dijo, a través de nuestra relación con BICE ya tuvimos la oportunidad de conocer a algunos de ustedes y espero que en el futuro podamos conocer a todos. Bueno, Commonfund es una organización que fue fundada en 1971 por una beca de la Fundación Ford, una de las fundaciones más conocidas en los Estados Unidos, con la misión de crecer los recursos financieros de sus clientes. Hoy estamos aquí representando a Commonfund Capital, que es el ramo 100% dedicado en inversiones en el mercado privado. Hoy en día, tenemos más que 18.7 billones de dólares en capital cometido por nuestras inversionistas en nuestros fondos. Desde nuestro comienzo ya levantamos 67 fondos, incluyendo 14 fondos de Venture Capital. Somos un equipo de 50 personas y tenemos una presencia mundial en 5 escritorios. Empezamos con Private Equity en 1988 y un año después hicimos nuestra primera inversión en Venture Capital. Hoy en día tenemos fondos de fondos, fondos directos y fondos secundarios. Dado a nuestra historia, siempre reconocemos la importancia de ESG y la diversidad. Desde 2013 firmamos la iniciativa PRI de las Naciones Unidas y en este último año recibimos la nota más alta del PRI. Los temas de ESG están siempre presentes en todo el due diligence que hacemos con managers. Además, dentro de Commonfund, estamos creciendo nuestra propia diversidad de raza y de género, tanto como estamos aumentando la revisión y due diligence de managers emergentes. Ahora, mi compañero Ralph, que trabaja junto con todas nuestras inversionistas en su construcción de perfil de inversiones y su allocation a capital privado, va a compartir un poco con ustedes. Ahora, Ralph, te toca a ti. It's your turn, Ralph.
Ralph, you're on mute.
Gracias. Good morning, and thank you, Danielle, for the kind introduction. And good morning, all, and welcome. Let me kick things off, if I could, with two reminders about why investors include private equity and venture capital in their portfolios. The slide on the screen now, again, is just a quick reminder, is that long-term investors, family offices, pensions, endowments, etc., very much want to take advantage of two premia available in the marketplace that I think are familiar to all, but just as a reminder, on the left part of the screen, we want to take advantage of the equity risk premium. Over the long period of time, the premium in the goldenrod bar of equity versus fixed income, for example, is just about 4%. Currently, and for the last several years, it's been running higher than the average, and today the equity premium stands at 5.1%. The second premia available, very important in private equity and in venture capital, is taking advantage of the liquidity premium, where investors who will be essentially locking up capital for 10 to 12 years wish and need to receive a premium for that liquidity risk they're taking on. Over longer period of times, that liquidity premium has been approximately 3 1/3%, and today that premium is running higher, 4.7%. Critical to this chart is that premium can be larger if you're able to research and access premium and better performing managers. Página 6, por favor. So on this chart, this is one of my favorite charts that we share with investors who are thinking about growing or implementing a private equity program or a venture capital program, is the dispersion in returns between median managers and top quartile managers. On the far left, I've plotted the 10-year annualized return of the S&P 500. You can see the dispersion of return between median of roughly 13.5% and top quartile of about 14.4% is very tight, and same on the bottom. In the buyout arena, here we're looking at US buyout type managers, there's much more dispersion between the median, in this case of 15.4%, and the 26.9 breakpoint of the top quartile. In venture capital, you'll learn more about this morning, the dispersion's even wider, where the median returns pretty much equal what the public markets yield. So the more interesting way to enter and invest in venture capital is the importance. It's critical to access those better performing managers. So in many ways, we at Commonfund believe that venture capital is more of an access class than an asset class. We're teaming up with really strong players is important. So with that as kind of context, let me introduce my partner, Aaron Miller, who's going on 8 years with Commonfund, who leads our venture capital investment platform. Aaron's got a remarkable background before joining us at Commonfund, working and serving at institutions such as Lazard, Barclays, and Lehman Brothers. Aaron, buenos dias.
Thank you. Good morning. Let's flip to the next page. So our mission is quite simple. We want to provide our partners or our clients unique access to venture capital opportunities. And we do that given we have a rich history with long-standing partnerships with our managers. We know the space, we're networked, we have relationships, as I mentioned, so we're able to get access because in this particular investment class or asset class, it's very important to have access. It's one thing to be able to identify the right managers to work with. It's another thing to be able to get access, and it's really access constrained. And we use our insights to make decisions on how to invest, that we've been able to draw together a global perspective with rich data to look at pattern recognitions and make innovative decisions about how we think about managing a portfolio to capture global innovation cycles. And so we'll spend some time in the next couple slides showing you that venture capital 20, 30 years ago was certainly a US only phenomenon. We now see it as a global phenomenon, but in each market, it's very unique, and you have to work with the right partners and understand the uniqueness of each of those markets. Let's flip to the next page here. In terms of our platform, As I mentioned, we've been investing in venture capital for 30 years. And so we've raised and invested 13 funds. We made our first investment in 1989. We've committed over $6 billion of capital, US dollars, since our inception. But more importantly, we've been able to realize or return capital to our clients in excess of $7.5 billion since then. And we've done that at an attractive return, over 2.2x realized return to our clients, as well as at a 28% net IRR. And the most important thing beyond just the cash is making sure that we're delivering on our promise to deliver exceptional performance, that we measure ourselves against the direct manager. So as if you had gotten direct access to Excel or Sequoia or Andreessen Horowitz. And so of our 12 mature funds, so these are those that are fully called and majority invested, we've been able to deliver top quartile or at least above median performance in all of our funds if you compare them directly with our manager set. And as Ralph mentioned before, the asset class is unique. It's important to be in category defining companies, so the largest companies, because returns are disproportionately derived from a few companies in venture capital. So the larger the winner, the most likely, the higher the return for the manager. So when you look at the last 5 years, we have exposure to 9 of the 10 largest global exits, so not just the US, so global exits. And the portfolio across our entire platform has access or exposure to over 30, I should say 300 unicorns. These are the billion-dollar startup companies globally. And so this is all done through a dedicated team in venture. So if we went to the next page here, I'm on the left-hand side. I've spent my entire career in technology. I started out as a management consultant for technology companies, and then did that for about 7 years, went back to business school, and then upon graduating, went into investment banking, working in mergers and acquisitions, capital markets, helping firms raise capital as well as make strategic acquisitions and investments. And so spent my, I guess, almost 7 years across the board in M&A, most recently at Lazard, where the back half of my career was primarily focused on cross-border transactions and from Silicon Valley, looking to make investments in India and China. So spent quite a bit of my time in those markets. I joined Commonfund just over 7 years ago to help run the program. And one of the first things I did was hire Luke. So Luke, why don't you introduce yourself?
Great, thank you. Thanks, Aaron, and good morning, everybody. So my name's Luke Rossiter. I'm a director on the venture capital team here at Commonfund. I started out as undergrad and postgrad as a law student studying law, and focused really in on equity financing, so helping structure private companies to list on the London Stock Exchange, so startups that were going public, and also doing some fund formation law, so LPAs and amendments. And really from drafting PPMs and LPAs, I started becoming very interested in the subject matter of venture. I was seeing what the managers' strategies were, what the types of returns that were available were for the very best managers. And so that became definitely a passion for me, and I moved across from law to fund investing. So I spent the first 7.5 years of my career based in the UK in Oxford, which is where I'm from, but I now live in the US and work with Aaron. I spent 7.5 years investing in venture funds globally. And then when I moved to the US around 5 years ago, I joined Commonfund. And so I'm a director on the venture team, work closely with Aaron across primaries and secondaries and direct investments too. Direct investments are something that Aaron and I have a lot of experience with, but we wanted to make sure, given it's been an increasingly important part of our program, we wanted to continue to add capabilities there. And so just over a year ago, we added Dave to our team as well, and I'll let Dave give his introduction.
Yep, Thanks, Luke, and good morning, everyone. So I joined Commonfund just over a year ago. My background for almost a decade has largely been in direct investing. So I started my career in San Francisco at a firm called Summit Partners. Summit largely focuses on growth equity and private equity transactions. I spent my time on the tech practice there, sourcing and executing a couple of transactions in the growth equity and late stage venture space across software and digital media and consumer internet. So I was really able to learn the different industries, work on quantitative diligence, and spent a couple of years there, and then tried my hand at building a startup directly. So I moved to New York, joined a company called Yext, which was in the marketing technology space, and was able to help drive our IPO process and open 2 or 3 of our international offices. And thankfully, we were able to go public on the New York Stock Exchange in 2017. After that point, I decided to get back into investing and help more companies based on what I learned at a growth stage company myself. And so went to business school and then joined the Rain Group, which is a tech and media focused merchant bank. So spent some time on mergers and acquisitions and also direct growth equity investing. They'd raised $1 billion fund to go after those opportunities. And then I came across Luke and Aaron and what they were building at Commonfund and saw an opportunity to really build our direct investment practice, help us underwrite more transactions ourselves and take advantage of some of the high quality deal flow we were seeing on that side of the business. Back to you, Aaron.
So I also sit on the investment committee of the organization. We have 7 members that make all decisions related to that, and we're supported by a number of other associates here in the US, as well as a global team based in Beijing and London that help provide kind of an on the ground local perspective with managers. But we also manage this centrally from Wilton and New York basis. And so, you know, you might ask yourself, why technology? I think let's move to the next page. I think it's an important asset class, but we've certainly seen a tectonic shift in our use of technology over the last 15 years, but certainly after the pandemic. The pandemic certainly was an awful event. It impacted us in so many different ways, but one of the byproducts of that was the realization on how much technology keeps us connected, allows us to transact, as well as to collaborate on a workflow basis. And so, you know, technology has been growing in importance beyond the pandemic. I mean, if you look at the last 10 years, on the top left-hand side, you'll see that the largest companies in the world have migrated from energy to technology. And so 8 of the 10 largest companies are technology companies, or 8 of the 10 largest companies globally are technology companies. And so it's important to recognize that there's been a shift in terms of where growth has occurred. The exits that we've seen have grown tremendously. So IPOs are now exiting almost 3 times larger in size than they did 10 years ago. That's a function of 2 things, I would say. One, companies are staying private longer, which means that the value of these companies are compounding as private companies rather than public companies. So in turn, the value creation is being shifted from the private investor to the public investor. And they're also attacking or trying to capture market share in larger markets, more global markets. And so that's one of the key drivers behind, you know, the record size IPOs we've seen. The larger the company, drives overall returns. So if you look at the bottom left-hand side, this shows the US exits by value and breaks them off by exits that were valued at 500 million or less, or 500 million or more. And you can see the majority, so almost 90% of all exit value was relating to companies that were valued at 500 million or more. So, you know, outliers or category defining companies, these large companies are driving the overall industry returns. And then on the bottom right, you can see that this shows the type of industries that these tech unicorns or technology companies are attacking or disrupting. And it may come across confusing, but that's by design, is that if you look at where technology is moving now, it's into traditional industries. So these are things such as agriculture, logistics, hospitality, transportation, so on. So that's beyond just you know, the traditional technology-based companies. So you know, I think the surface area of opportunity has never been larger. Let's move to the next page here. Luke, do you want to take this one?
Yeah, sure. So there's two trends that we're showing on this page that we've observed in venture capital over the last 15 years or so, and that's that venture capital companies and venture capital exits have become much larger and much more global. So much larger meaning when a company exits, it's a much higher valuation than in previous years. And so you can see on the left of this page here, we have different colors for different 5-year bands. So at the bottom, the dark blue is 2006 to 2010 period. And the bar on the right-hand side of the key there shows the aggregate exit value of the 10 largest venture-backed exits in that time period. So the 10 largest, be it IPO or M&A events that happened in 2006 to 2010. And in aggregate, those companies make up about $22 billion of exit value. So on average, around 2.2 billion per exit of the largest 10 companies. And if you look at the two bars above that, so the 2011 to 2015 period and the 2016 to 2020 period, you'll see that those bars grow much, much larger. And so if you look at 2011 to 2015, the aggregate exit value created from the 10 largest exits in that 5-year period is near 200 billion. It's about 192 billion. So it's grown very vastly in that time period. And then if you look forward to the most recent 5-year period, the aggregate exits top 350 billion, meaning that each on average is worth 35 billion or more of the 10 largest exits across this time period. So we can see, and Aaron touched on this, that companies have been staying private longer. They've been spending more of their life as private companies before hitting the public markets. They're growing more revenue and in some cases more profit before going public. And so their valuations are rising. And when they actually go public or acquired, they're doing so now at valuations much higher than in the past, which we think is a positive. We're private capital investors, venture capital investors, and we're seeing more of the company's value accretion happening on the private markets versus historically, which would have happened on the public markets. And if you think back to some large public companies now like Amazon and Google, those went public much earlier in their life at much lower valuations, and they've rose up on the public markets. And so public market investors have taken some of those gains. But more recently, we've seen those gains accruing to the private markets, which again, we think is a really strong indicator for the health of the venture capital ecosystem. So exits have become much larger. The other thing that we've observed over this same time period is that the exits have become much, much more global as well. So you can see the second column is US market share. So this is the percentage or the number of the top 10 largest exits in each period that came from the US. And so if you went back even beyond this chart, most of the venture capital activity globally was actually in the US, and within the US, it was mostly in Silicon Valley. We are seeing innovation happening in a lot more areas today and a lot more geographies, and that's playing out in the numbers. And so if you look at that 2006 to 2010 period, 9 of the top largest exits in that period were US-based companies. And if you fast forward to today, you'll see that 60% or 6 of the largest 10 have been in the US. So clearly the US is still a strong contributor to innovation, to venture capital ecosystem, and to the types of companies that can be built and exited. But Also, there's a 40% coming from ex-US, and so the rest of the world is really caught up in having an entrepreneurial spirit and having the ability to build big companies and big outcomes. And the third part of this chart is CCI, which is Commonfund Capital venture exposure. So our fund's exposure to these companies in each time period. Venture is an asset class, as we know, where the lion's share of returns are driven by a handful of companies in each year, and you can see that from this chart. And our program is really built about accessing the managers that we think can persistently access those types of companies. If you're not in the largest companies, the largest exits, it's very, very difficult to have strong net performance. And so we're proud that if you look in 2006 to 2010, in the bottom right in the dark blue, we have 100% or 10 of the 10 largest exits. That was back, obviously, as I mentioned, when it was mostly a US affair. So 9 of 10 were in the US, and we had all 10 of 10 globally. And if you look today, 2016 to 2020, you'll see that our exposure or our hit rate to these largest companies remains at 100%. So we still had 10 of the largest 10, even though venture has become more democratized, it's become more international. So we think that really speaks to the managers that we're picking to work with in our different geographies.
Great. So you turn to the next page. I can take the next couple. This is our point of view. It's been very consistent over the last 5+ fund cycles, so 10+ years. Really, it's about disruptive innovation. And so Aaron had spoken about the technology effect. We think that is the leading driver of innovation globally. And our thesis is technology is disrupting all industries, and venture is the best way to get exposure to that innovation. And so we've continued to invest behind that trend. If you look at sector, again, tech focus, that's largely software, tech-enabled businesses, IT disruption in sort of traditional industries like healthcare and financial services. Particularly in healthcare, we're seeing approaches that are largely software-based to help reduce costs in the global system, increase efficiency. We're seeing that in global disruption of financial technology and things like blockchain as well. If you look at stage, we have a bias towards the early stage. If you looked at our portfolio construction going back to CVP 9, so 10+ years, it's been roughly 2/3, 1/3 early stage versus venture growth. And that's largely been by design, where we want to get into the leading companies and those leading outcomes as early as possible. And so you'd look at, a lot of the outcomes that have driven returns in the venture space, and we've typically gotten exposure to most of them in the Series A or Series B, sometimes even in the seed. And so we've been trying to do this for 30 years with a strong track record. If you look at the geography, this has also been fairly consistent. It's a predominantly US focus, but we do have global exposure. We think it's important based on getting exposure to as many IPOs as possible, which is something that Luke touched on the previous slide. And so if you look at the US focus, we've been about 60%. We'll try to maintain that. China is an important venture market, and we'll talk about that more later in the presentation, but we'll continue to have exposure there, supplemented by exposure in India, Europe, and Israel as well. And then if you look at the portfolio construction, we've always been focused on maintaining a very concentrated set of primary managers. So call it 20 to 25 managers in any given cycle. If you look at venture capital as a whole, there are 1,000, 2,000 or more venture managers. So we maintain a very high bar. We want to make sure we're in the right names that are getting us exposure to the right outcomes, and we'll continue to do that. And then, of course, we're supplementing it with select direct investments where we get a more concentrated position in some of our managers' highest conviction portfolio companies. And in CVP 13, that was 15% of the fund. We will target the exact same percentage in CVP 14 as well. And then we have a pocket for secondaries, typically less than 5%. And that'll be when we manufacture an opportunity to get exposure into a company that we have high conviction in, typically earlier in the fund's life cycle, given the higher IRR, faster cash back, and ability to recycle. And it helps mitigate our J curve when we start out the fund. If you go to the next page, this is a graphic representation of some of the things I just talked about. So if you look at the top left vintage year, it's largely going to be split between 2022 and 2023. We will have some minimal exposure to 2021 and 2024 vintages as well. And we have some line of sight into 2021 commitments. This is the plan for the CDP 14 new funds. Again, construction is relatively the same as we've had over cycles, more global, concentrated set of managers, direct and secondary investing. And so if you look at the top right geography, as I sort of mentioned, 50 to 70% US, China will be 20 to 30%, likely closer to 20% in this fund. Europe, we're seeing some very strong performance there and a bench of very strong unicorns. And so we'll probably dial up our exposure there 10 to 20%, likely on the higher end. India will be 5 to 10%, and we've left some optionality for other geographies, but may not happen in this fund. In the bottom left, we mentioned diversified IT. That's going to largely be our focus area. We'll have select healthcare exposure, but again, most of the healthcare will be software-based or tech-enabled healthcare companies. So there's sort of a gray area where it falls into IT as well. And then if you look at the bottom right, we'll target 80% primaries. We have 15% exposure to direct, which was in line again with CDP 13, and then less than 5% to secondary. So if you go to the next page.
Let's just follow. Let me just end this prior page real quick. And so what we're going to do with this upcoming fund is consistent with what we've always done. We make some tactical changes across the levers of the fund, but we want time diversification. We think that's important, so we'll be investing it over a 2.5-year period. We want geographical exposure to the global innovation cycles, so we'll follow a similar approach we've done historically, but fine-tune how much we invest in each geography. We want to have a technology-focused strategy, but it captures most of the leading trends in fintech, e-commerce, cloud computing, big data, blockchain, enterprise software, consumer software. So it's capturing kind of all the major trends you hear about in venture. And we'll do that through commitments to managers, but we'll also complement that with co-investments with our managers. So we call those direct investments in their category defined companies that can offer a meaningful, an attractive risk return profile for the fund, and then hopefully, show kind of immediate or short-term gains, and then shorter duration investments. And so we'll follow this strategy, this playbook. We think it's important. You'll see in our track record that we think this portfolio construction provides, meaningful, return and risk mitigation when you think about delivering returns back to our clients. So let's move this next page here. So this is our manager set. And so this is not a wish list. This is who we work with today. The Fund 13, which we're just finishing up today, has the majority of these names in the fund, and we expect these managers to be in Fund 14. Some of them may come across very recognizable. It's probably those in the middle column, which we call global managers, where they have they may have been founded or headquartered in the U.S. or in the example of Index in Europe, but they've gone on to become global in nature, where they've created teams as well as funds and individual markets, and they're certainly one of the most recognizable managers globally. But if you look at all the managers that we have here, they're access constraints. So these are groups that in their markets, they're very well known, very well respected. It's difficult to commit capital to them. They each have a very unique, differentiated strategy. We think that they provide a complement in terms of how we put together the composition of our list. In many instances, we think it's a very bespoke list, so it's very tailored. And we're very excited about who we work with. I mean, there's some managers here that we've worked with for upwards of 30 years, like Sequoia, and there are others that we backed that are on Fund 1. There's a number of groups on this page that we've anchored or helped institutionalize them in Fund 1, and they've gone on to become larger organizations. But Luke, maybe you can spend some time talking about our new manager strategy.
Sure. So as Aaron said, we've been consistent with many of these managers in some cases for many cycles, and some are newer. And we're always keen to look at the investment landscape. We meet with hundreds of managers a year to improve our network and to see what could be the best funds of tomorrow. And so we are active in adding managers each cycle. We typically add maybe 3 to 4 new names every kind of 2 or 3 years. And so I can talk you through a couple of more recent additions to kind of tell you our strategy and how we think about adding managers. And so, for instance, in the US, you'll see at the top left, there's a group there called A Capital. So they're a seed and early stage focused firm based in Silicon Valley. And they do about half of their investments in enterprise technology, so B2B, business to business software. The other half is in consumer and fintech. This was 2 individuals, so it's a 2 GP firm. They have a small fund, very focused strategy. Each individual previously was at Andreessen Horowitz, which is the name to the left of A Capital on this slide. They were involved in Andreessen's seed investments, including things like Airbnb, which obviously went on to become a large company and a large IPO. And so, you know, this is a group that we knew. We are investors with Andreessen, so we were able to underwrite their track record, their network, their credibility. And so whilst it was a group, you know, with a new fund, it wasn't new to us, and you know, that's one aspect that we like to do. We like to use our network. We like to back early new managers where they have an established track record. They've returned money. It's not just a story. There's a lot of data and evidence there, and they come well referred within our network and our GPs. And so that's one example on the US side. And on the ex-US side, you'll see there's a black logo there called Into, INCE. And this was they're now on Fund 2. They raised their Fund 1 about 2 or 3 years ago. An individual that we had known very, very well. So the lead GP there is an individual called JP Gan. He spent the last 10 years of his career at Qiming, which you'll also notice there is in that China logo. So we sit on the advisory board of Qiming. We've been investors with Qiming since their first fund. That at one point was a new manager for us as well. They're on Fund 7. And over that time period, we got to know JP really, really well. He led their Intersuma, which is kind of internet and consumer practice at Qiming. He had an incredible track record, including lots of distributions, which are key to venture. And so when he decided, as Qiming became more equally focused on healthcare and tech, he wanted to leave and start a dedicated tech practice. And so he reached out only to the advisory board of Qiming, and we were on that advisory board, as I mentioned. And so we were early Fund 1 investors at Qiming and now at Into as well, where we sit on the advisory board. So we are constantly meeting new managers. We do like it when they're referred by our network. We think it gives extra credibility. We can triangulate all the touch points that we have and the contacts we have in the industry to vet and choose the best managers. And we're very selective about adding managers. As I mentioned, it's kind of 3 to 4 a cycle maximum. Some cycles we don't add. We think the group that we have here on this page is incredibly strong, access constrained managers. And if we add, it has to be accretive. We want to make sure that we're not diluting the strong pool that we have here.
So to close on how we think about working with new groups, I mean, Andreessen Horowitz is obviously a well-known brand now, but we first were introduced and started to work with them in the beginning of their formation. Thrive Capital, we were anchors in their first institutional fund. They're now on Fund 7, highly oversubscribed. General Catalyst, we worked with starting the very beginnings of their franchise. They're now a very well-known US brand. And so, it goes across the board that we typically like to add anywhere from 2 to 3 new managers per cycle. We're very selective about how we add, but we do think in venture, there is persistence. So the ability to generate top quartile performance cycle after cycle is more clearly evidenced and illustrated in venture. But we also want to make sure we're working with the next generation, what we call franchise building groups, as they create a meaningful brand. Let's go to page 15. This shows our track record over the last 10 plus years. We provide our track record since inception in the back. You can look at that at your leisure. But these are the last, call it 5 funds dating back to 2010 with what we call CVP 9. And I think CVP 9 is an important fund to look at today, because that is the basis for how we've thought about portfolio construction fast forward to today. CVP 9 was our first fund where we were completely technology focused investing. We started to have a global perspective. We started to invest, co-investing and direct investing in companies. We did less of it in 9. And then when you look at fund 11, 12, and 13, we've done more direct investing in the funds. We've curated the weights that we've thought about in each geography. But I think, this is a good manifestation or representation of how we think about portfolio construction today. And so CVP 9 was a 2010 vintage. So we committed that in a 3-year pace, or I should say about 2.5 year pace. And so the fund is about 97% called today. It sits at a 4.7x net multiple and about a 26.5% net IRR. And we returned, as of at least June, for every dollar that was invested by our partners, we've returned $2.20 back to our partners, so a DPI of 2.2 times money. And if you look at where this fund is, it's at a peak harvesting stage, and so a third of the capital remaining net asset value of this fund is in public security. So these are companies that have gone public or IPO'd in recent 12 to 18 months. And so every day we're getting capital back as our managers start to distribute those shares. So we think this is a meaningful fund, and it's done quite well. CVP 10 was a further refinement of this, and so this has just started to hit harvesting. We started to get capital back pretty quickly about 18 months ago. So the fund sits at a 3.7x net multiple and about a 25.9% net IRR. And we've returned $1.10 for every dollar that was been committed. And so that fund, for instance, is starting to be harvested quite quickly. And so I think we went to one point, we almost delivered 1x DPI in the last 12 months. So we're very excited about the capital that's coming back to that fund. CVP 11 is another fund that we think has got meaningful return potential beyond where it sits today. It sits at a 3.1x net multiple on invested capital and about a 36.7% net IRR. And so if you look at this particular fund, which was invested in 2015, 16, 17, so in many respects, it's just about a 4.5-year-old fund. We have over 35% of the net asset value. So this is a 3x. So that's over 600 million of capital is already been IPO'd or in public security. So we think this fund should reach DPI or at least 1x DPI faster than we've ever seen it. So a lot of exciting companies in this portfolio. there's at least one company that's in our direct, or I should say 2 companies in our co-investing direct portfolio that have filed to go IPO. So hopefully we'll have news in the coming weeks and start to see capital back on our direct investing. And then CVP 12 is still early. It's not fully called. You can see it's 75% called, but it's starting to get there. It sits at a 1.7x net, 48.6 or 48.5% net IR. So, we think it's just starting, the early stage portfolio just starting to be invested, just starting to show progress, but really strong returns out of the gate. But we're very excited with the complexion of this portfolio. And then lastly, the fund we're just wrapped up is just it's pretty remarkable how quickly we've seen that fund progress. And so that's about 55% called. So it's still has some ways to go, but it's sitting at 1.7x net, and then a very large net IRR. And that's a function of what we've done in our co-investing and direct investing. So the vast majority, if not all, of what we've committed to our primary strategy, which, if you remember, is 85%, hasn't been called or is just starting to be called. So very, very early. So everything's being driven off. We did about 16 co-investments, and about 7 of them have either exited or had up round financing. So it's really the direct portfolio. It's driven the performance out of the gate. So still very early days, but we think the portfolio construction, the way we've constructed our point of view, is off to a great start. And so which brings us today, what we're thinking about going forward. And so we've completed and wrapping up the investments we've made in CVP 13, and now we're thinking about CVP 14. So if you move to the next slide, Danielle, you'll see what our plans are for the next fund. And so we're going to follow a similar strategy that we've employed in the last couple cycles. We're going to raise a $600 million fund. That's our target. Our last fund, CVP 13, closed at $625 million at its hard cap. It was oversubscribed. So we're going to follow a similar approach in terms of size. It will be global in nature with a US-led strategy. So 60% will be US, 40% non-US, with an early stage bias. So this is a consistent strategy where we'll call it 2/3 early stage, 1/3 venture growth, and it'll be tech focused. We may do a little bit more on the healthcare, the intersection of healthcare and technology, but really a technology focused strategy. Same portfolio construction. So we want to concentrate with the best managers. So less than, we're going to target about 22 managers. And so we want to concentrate with the best managers that are able to get access to category defined companies. We'll do direct or co-investing similar to what we've done in the last couple funds. So 15% of the capital will be directed towards direct investments, so co-investing with our managers in their most leading or driving companies in their portfolio, with a select number of secondary purchases to help get cash back quicker, as well as mitigate the J curve in the initial couple of years of the fund. So the same playbook, the same strategy. Not much change. We'll probably do a little bit more in Europe this cycle, a little bit less in China, but on the margins, we think the portfolio construction matters. And so we're holding our first close in November of this year, November 19th. We're going to do a 2-part close. First close, one in November, one in January. We have a number of clients that want it to be a quote 2022 closing, and so they will do one on November 19th this year, and then January 15th. There is a first close discount associated with these closings that represent about 10% reduction in the management fee. But we're looking to add select new investors. We've had strong support from our existing investors. So we have already started to gather some subdocs and commitments for our clients. And so when we look at our pipeline going forward, we're very excited. We already are starting to diligence a number of co-investments as well as primary commitments that would go into this fund. So, when we look at the next, call it 6 to 9 months, we have a pretty hefty and strong pipeline for commitments for this next fund.
Hey, Carles, this could be a good time to invite the audience to suggest questions for the team. And maybe Danielle, if you can go back to page 14 for a moment. What we have observed in our conversations with our longtime and newer investors is many of our investors use our program as their venture capital exposure. We think it's a complete solution for investors who want and need access to venture capital, innovation, disruptive technology, etc. We also work with a number of investors who use our program as a core, but have developed or have access to a couple of these managers directly, which we think is terrific. And others will often include local managers in the venture capital space within their home country or community. So the flexibility of how we see our investors utilize our program really runs the gamut, from a complete solution to a core solution on which they can build satellite commitments around. Carles?
Thank you, Ralph, and all the team from Commonfund, and the remarkable track record you have. It's quite impressive to see for how many long you've been in the industry with those track records. So first of all, thank you for being today, and congrats for those figures. So I think the first question is something you mentioned at the beginning, Ralph, about this is a different, is not an asset class, it's an access class. So and you have, Aaron, Luke, and Dave mentioned that how important it is to get access. You mentioned the difference between the top performance at the bottom in terms of how to get the right deals based on the right relation you have with managers. And with this slide you have mentioned, those are some big names, brand names that in some cases we know here in Chile, but can you tell me a little bit, how do you get those access? Because I mean, everyone wants to knock the door on some of those brand names and get exposure to those deals, but we know that in some cases quite difficult. Sometimes those managers don't get your the attention. So if you can elaborate, how do you get the connections? How do you get those relations? So how do you build those relations in time? So if you can elaborate on that, but I think that's the most significant part of it. How do you get those deals? I don't know if Aaron or Luke.
Sure.
It's up to you.
Yeah, so it's interesting. Most asset classes, managers are seeking capital, and that's not the case in venture, where they have so much demand from folks to work with them, and they can only put so much money to work, that they're very selective about who they want to work with. They're going to choose partners that they think, align with their mission, represent the right organizations that add value, and many times they want to work with people who are very sophisticated, so understand the space. And so it's not about saying I can write a large check. That's really not what matters to them. And so if you look at our heritage, we started out 30 plus years ago representing endowments. And then we started representing endowments and foundations. And then we started adding hospital systems and then pensions. And so when our managers look at us, they look at us as a mission-driven organization that represent so many important organizations that they find are meaningful. They may sit on investment committees at schools, at other foundations, and they may hire us to invest their money on behalf of the institutions they represent. And so who we represent matters. The fact that we've been doing it 30 years, I mean, there is a brand value to our organization. I mean, some managers come to us because they know that we work with the best, and they say, can you provide some analysis about what the best managers are doing in X, Y, and Z matters. And so we have the ability to draw on what the leading organizations do, and we use this to add value consistently. So for instance, last night I sent some analysis to a leading manager on what we're seeing in terms of distributions, the policies, the benchmarking, and so on. And so we do this routinely, and this database matters because it's not just something that is industry data. It's really tailored to organizations that or I should say top GPs we work with, and so that matters. And then the last part is really network. I mean, I sit on 10 advisory boards. Luke sits on a handful. We've been on over 100 advisory boards as an organization. So we have an intimate seat in these marquee managers. So there might be 5 organizations that sit on these advisory boards and routinely provide counsel and advice and get an inside look at what the manager's thinking and what they're trying to do in terms of portfolio construction. And so having that intimate relationship matters, and having that seasoned perspective to draw on in a number of instances. So we bring this all together, and it's really about the network we bring, the brand we bring, as well as who we represent. And we'd like to be very discreet. We like to be good partners, and we use that to ensure that we get the best access we can for our clients.
And I think too, Jose Antonio, the managers definitely value what we bring, who we represent, but quite frankly, we're also not only value add, but reliable capital, as well as intellectual capital in the relationships that Aaron outlined. All of those combine to make us almost a preferred limited partner. So we use that to the advantage of our underlying investors to gain those access to build the portfolios.
Thank you, Ralph. Aaron, building what you mentioned about in this category, managers don't look for money. I mean, it's something that in our mind made a lot of sense, because we're seeing the large private equity looking for a lot of money, and those funds are getting bigger and bigger. So now every year we have new records on AUM in the fundraising side, but in your case, as you mentioned, the VC managers don't look for money, they look for deals. And so my question is regarding about the size of the fund you have fundraised. Almost all of them, above all of them, around 600, something like that. So quick question regarding how your fund is not getting bigger, as we are seeing in other PE landscape, for instance?
Yeah, I'm happy to take a first.
Please.
Yeah, sure. So I think you hit on a critical point. They're looking for deals, and so they're looking for the types of entrepreneurs who are world class, the types of entrepreneurs who can have a game-changing idea, can galvanize a team around them, and can really create a large category-defining company from that idea. And so those types of individuals, they are they're limited. So that compared to private equity, the investable landscape is different, and so the funds don't scale too much at the underlying fund level in terms of our VCs. They raise slightly larger funds depending on the valuation environment. If they want the same amount of companies, they want the same ownership in those companies. So, but the funds relatively stay flat compared to private equity, and that means that our funds stay consistent too. We are concentrated with the very best managers. We could raise more capital and add probably 20, 30 managers, but we think that would dilute the potential of this. We really want to focus in on the strongest managers, and those managers are working with the strongest entrepreneurs. So we want to remain top quartile in terms of the managers we pick, in terms of our own fund performance, and we think we can do that from having a concentrated, dedicated strategy.
But just to add a final point, we've maintained a disciplined fund size by design. Our underlying managers, until about 5 years ago, maintained same fund sizes throughout. And so private equity, they can double or triple their fund size every cycle, and they get to the point of billions and billions of dollars. And so venture has experienced a bit of change where they are raising a bit more on the growth side, And what we've just done is, instead of working with 28 or 30 managers, we work with 20. And so instead of saying we're going to raise more capital, we're just work with what we think is the strongest managers. And so just keep concentrating the portfolio that generate what we think is the strongest returns. I mean, if you went back a number of cycles, I think at the peak we had 30, maybe I can't remember the exact number, maybe 35 managers. You know, this cycle we have 22. And so, you know, our job is to make sure that we're going to get the best return for our clients and the organizations they represent. And so we spend our time thinking about how big the addressable market is, what are the portfolio construction looks like, what's the differentiated strategy, can it support the amount of capital they're raising, and you know, what's the data show out, and what's the portfolio prove out. And so that's where we spend our days, day in and day out, thinking about that.
I'd add, Aaron, to your points before, the core is around that solid group of franchise firms, but I think the other value creation component is the work you and the team have done by carefully adding select direct investments alongside those high conviction managers and being very opportunistic in the secondary arena as well. So the combination of working with very solid core managers, having portfolio construction also be a driver of return. A very dynamic portfolio has in part driven our past success, Jose Antonio, to your earlier question.
Thank you, Ralph and the team. I think we are almost reaching our timing that we have for today, but I have a couple of questions. Maybe we can go for it. And the first one is regarding the dispersion in returns, comparing. You mentioned in one of the slides the returns in the buyout landscape, and how that is rather than smaller than the VC landscape. So the question we have here is why, if we have some dispersion in the VC landscape, why we shouldn't focus on the PE landscape with the general buyout. So it's like the dispersion doesn't pay the returns we are receiving the other category. So your question, maybe the question is how to select this category, these asset classes, where you can have almost the same return with less dispersion in the large buyouts.
So maybe I'll take the first part of that. On the venture side, several of the points we covered this morning, it is about access, and it's only through access to those top tier managers can you have those outsized performance. And the other point regarding venture is punctuating a point Aaron shared, is that we've witnessed really important persistence in the performance of those top managers cycle over cycle. And in fact, that's probably the most persistent performance we see in any asset class: stocks, bonds, buyouts, real estate, et cetera. So that's the venture capital side. On the buyout side, Jose Antonio, if we were to take the industry data and segment it by fund size, the data I showed earlier is heavily weighted to those very, very large and mega leverage buyout firms. But if you were to stratify, segment those buyout firms by size, you would see larger buyouts close to or a little below the median. You would see smaller, medium-sized funds above the median, and then smaller sector specialists way above the median. So from a portfolio construction sense, it's our point of view on the buyout side is tackle the opportunity set with a small number of sector specialists that are backing smaller companies with smaller funds with a lot of influence over the companies they are building, value add they do. So that's how we kind of bifurcate the market. But to Aaron's point before, the venture side, it's if you're able to access the top tier and identify early the potential next tier, that's the formula for success we believe in. And that's some of the data that Aaron showed. Aaron?
Yeah, I would just say, listen, I don't think venture is an asset class everyone should get into. I think you have to work with the right partners, full stop. And I think if you believe that technology is going to be an important part of our our global economy, our society. I think the best way to do that is through venture. So if you have a view that technology is increasingly going to become a critical part of our society, our economy, then I think venture is the way to do it, but you have to work with the right partner. And so if you were to look at the median or the top quartile, I mean, the dispersion's big. So when someone says, I'm raising a fund and I'm going to do great venture deals, you got to be wary, right? It's got to be someone that's got the network, it's got the brand, has a track record, that has the right team together, and they have the right strategy. And so that takes a seasoned investor to be able to work through that and reference it quite a bit, have a point of view where you can actually talk to entrepreneurs and other investors because they work intimately with these types of folks and get a perspective. But if you were to look at the median and the top quartile between private equity and venture, it's 300 to 400 basis points higher. So if you compound that after a period of time, that's a meaningful return above. I mean, and so you can compound growth quite a bit, but you have to get the right partners. I think, there's been a proliferation of new venture managers. I mean, if you look, we've put the data together over the last decade, and we're meeting with anywhere from 10 to 20% more managers per week than we have over the last decade, because everyone says, I have a venture strategy I want to put together. Well, we're very cautious because the number of managers in venture has grown, but the dispersion still grows. So it's really about working with the right folks. But if you have a point of view that you believe that technology is going to be critical to growth going forward, then that's, I think venture can be attractive, but you need to work with the right partner. You got to recognize there's dispersion, but you're also going to take on more risk. But the premia or dispersion between the median and top quartile between private equity and venture can be anywhere to 300, 500 basis points, depending on the cycle.
Thank you, Aaron. Guys, I think we have a run of time. So first of all, congrats regarding this 100% of hit in this figures IPO that I mentioned. It's something that in some points, it's a summary of what you have been doing for so many years. So congrats for your performance and all the work that have done by the team. And for all the audience, muchas gracias por acompañarnos esta mañana. Esperamos que esta presentación haya sido de su interés desde ya y por supuesto estamos a su disposición para cubrir las preguntas que no alcanzamos a responder y entregar más información. Nuestro equipo está disponible para poder atenderles de la mejor manera. So, thank you very much for the Commonfund team. Guys, we really enjoyed this morning. Congrats again and see you soon, hopefully in person in the next, I don't know, couple of months maybe. Who knows? Okay, thank you very much, guys, and see you. Gracias a toda la audiencia por acompañarnos hoy día en este webinar de Commonfund en BICE Inversiones. Gracias.
Gracias.